So initially what I will do is that in my part of the presentation, I will talk a little about the state of the Indian economy. When we want to invest, when we want to take a meaningful exposure in any country, it is always very important to understand what is the state of the economy as of now. So when we talk about the state of the economy, today every discussion would revolve around the winds of change which are blowing across the world. And India is no exception. In fact, India has been inflicted with a tariff of 50%, which is the highest rate of tariff by the US to basically any country or the group of countries in the world. The only country other than India which has been inflicted with that rate of tariff of 50% is Brazil. But fortunately, there are some of the sectors in the Indian economy which have, or which rather would not be impacted by this tariff. The first being the pharma sector. And there is some good reason for the US not to do so, because 50% of the generic drugs which are used in the US are manufactured in India. So any tariff on these pharma goods would lead to an increase in the cost of healthcare in the US straight away. The another segment which has not been impacted is the IT services, which is also a major component of services export from India. And because it is services, it is not a part of this tariff which has been inflicted. And the third important segment is the manufacturing of electronic goods. Big time manufacturers like Apple have set up their manufacturing facilities in India, and that has also not been impacted. But the sectors which are more labor oriented and they have been impacted are garments, gems and jewelry, engineering, leather goods. So in a country like India, where these kinds of labor oriented sectors are impacted, this definitely leads to a certain amount of peripheral impact on the sector and the sectors which are connected with it. India basically is not an export-driven economy, so tariffs straight away might not impact the way the country is moving. But according to certain estimates, India's GDP might decline by 0.5% or 1% if the impact of tariff continues the way it is. But since last 1 week, the news which has been going around is that there is a certain level of dialogue which is going between India and the US, and these tariff rates would get quite normalized in a little time. India, on its part, is also realigning itself very strongly with the BRICS nations. BRICS, as we know, is basically a setup which is a combination of countries like Brazil, Russia, India, China, and the South Africa. And this realignment is going to make or build new equations in the times to come. Our country, India, is a country which has always been resilient to face challenges as which have been put forward before it. And it has successfully dealt with those challenges. On the macro front, India's GDP growth rate is quite at a satisfactory level. For the quarter April to June 2025, the rate of growth of the Indian economy was at a rate of 7.8%, which was a pleasant surprise to most of the observers who were looking at India. Insofar as the monetary policy of the central bank is concerned, in last 1 year, the interest rates in India have been reduced by at least 1%, which is 100 basis point. and the repo rate in India is at a rate of 5.5%, which is quite a rate which is attractive for the corporates to borrow. Inflation for the month of August was just at the rate of 2%, which was at a rate which is quite an acceptable and a rate which is not at all worrisome. The fiscal deficit of in the budget, which was placed before the parliament for the year 25-26, was at just 4.4% of the GDP. In contrast, last year, India's fiscal deficit was at 4.8%, and country like US has a fiscal deficit of 6.1%. So, insofar as the government finances are concerned, it is quite in the healthy state. The government policies on the way the economy should move ahead are quite proactive and friendly to the way the economic development can be supported. The government is cognizant of the fact that consumer demand in India is a little slow, and the impact of the US tariffs might impact India. So they have been very fast and they have made very significant changes in the indirect taxes of the goods in the goods and services tax. These reforms, coupled with the changes in the direct taxes laws, which are going to give a lot of concessions, will and is estimated to give a lot of boost up to the consumption demand in the economy. As far as the way the Indian growth story is working, it is more led by the services, and manufacturing in India all these years have not taken or kept pace with the way the Indian economy is growing by and large. But of late, manufacturing also is picking up. Production-linked incentive is making all the difference for big-time manufacturing in India. Coupled with that, there is a lot of infrastructural spend. There are steps which are being taken for ease of doing business. And last but not the least, the central bank of the country, the Reserve Bank of India, has allowed the depreciation of the Indian rupee. And as it is discussed in some of the quarters, this has been a deliberate attempt to see that Indian exports are quite competitive and imports become expensive. So this was basically something which China did 20-25 years back to support their manufacturing. So in a subtle way, this can also, and this will also encourage manufacturing in India. The global headwinds, as I initially said, are a little uncertain, but the way the Indian government is responding is that it is keeping its national interest at its supreme. And this is what is the matter of pride for all of us who are definitely very much Indian at heart. With these words, I will hand over the further course of action to Rajit, who will deliver the formal presentation on the subject as discussed by Mr. Vipul Patel. Thank you.
A very good morning to all the participants who have joined today. I hope my screen is visible. It's always a great opportunity to interact with all of you to share our knowledge and financially empower each one of you wherever you are located. As we begin today's webinar, we have divided it into two parts. The first being taxation and regulations, and second being investment planning in the present era of the changing landscape of taxation, regulations, and investments in India. Beginning with the regulations that too regarding banking, because as we know, banking is the tip to enter into any kind of financial activity in India. At present, NRIs, basically persons who are outside of India, are not allowed to hold resident Indian savings account as per the present regulations of the exchange control law in India. So the resident accounts needs to be either closed or converted into the NRO account. Understanding the different kinds of bank accounts in India, NRO account is the account which gets converted when the resident account needs to be switched and a person living in India moves outside of India. Uh, this NRO account is a non-repatriable account, meaning funds cannot be directly moved outside of India from the NRO account without undergoing certain procedures. The interest income is taxable in India for the NRO account, and it can be held jointly with any other NRI. It's a rupee denominated account, naturally, and the loan can also be availed against this account. NRE account is a repatriable account, meaning funds can come to the NRE account from outside India, and it can go freely outside of India from the Indian NRE account. And it's also a rupee denominated account. As far as the interest incomes from this NRE account balances are concerned, they are tax-free in India. And all the investments that might be done through the NRE account are credited back to NRE account, so they remain freely repatriable. Similarly, loan can be also availed against the NRE account balances, and it can be held jointly with a resident relative. FCNR are a kind of deposits in India, which can be held with Indian banks in any other currencies other than Indian rupee. And the interest on these deposits is also tax-free in India, similar to the NRE balances. And loan can also be availed against these balances in Indian rupees, and that can be used for any kind of financial activity in India. That is, this is one of the ways in which many of the NRIs plan to hedge the foreign currency risk and to invest in the Indian opportunities. A common question that we receive whenever we discuss about banking is that, as you say that NRO account is a non-repatriable account, is there a means through which we can move the NRO funds outside of India? The answer to that is yes. NRO funds can be moved outside of India through under this procedure of the RBI, which is a relaxation that has been given, wherein to the extent of 1 million US dollars per person per Indian financial year, any NRI can move funds outside of the NRO account to the NRE account or directly outside of India. The only requirements to make this happen is that the taxes, whatever are there in the NRO balances, should be cleared. Then there is a simple just certification by a chartered accountant, which needs to be submitted to the bank, and for basis which the bank can allow the remittance of to the extent that I mentioned. PAN is the taxpayer identification number of India. It's required to transact into anything, basically any kind of major financial activity in India. So it is the primary activity where whenever any person who is living outside of India wants to start any kind of the simplest financial activity in India. Another common question that we receive is that if I have a PAN and if am living outside of India, then do I need to file my income tax return every year, irrespective of the fact that I am not having incomes or not having incomes and transacting in India? The answer to that is no. The requirement of filing the tax returns is only in these situations that we have mentioned, wherein when the income crosses the basic threshold of 4 lakhs of rupees in the Indian financial year, or if someone wants to claim refund of the taxes that have been deducted. So wherever there is any income that any NRI has in India from any kind of activity, predominantly which has to do with the financial institutions, which is the any kind of investments that they do or any kind of taxable interest that they receive, then there is a TDS, a withholding that is done. And if someone wants to claim refund of it, then the tax returns are mandatory to be filed in a scenario when the income is not crossing the basic threshold. Even when someone has got a loss and someone wants to carry it forward, then return filing is required. And the fourth scenario is when someone has entered into significant financial activity in India. In those situations, return filing is required. I'll not go into details because there are a lot of such situations. But to summarize, whenever there is a significant financial activity that has been taken place in India, then return filing may be required. In other cases, it is not required. Aadhaar card and OCI card. These are two different identification documents for which a lot of people have a lot of questions and confusion. I would like to clear all of it at once right now. Aadhaar card, firstly, is a social security card in India, and it is only eligible to be obtained by either persons who are Indian passport holders, or if they are foreign passport holders, then the condition is that they need to be in India for more than 182 days in the past 12 months, in the preceding 12 months from the day at which we are analyzing. So if we are taking today's case, then prior to today's date, which is 20th September, a person needs to be staying in India for more than 182 days in the exactly preceding 12 months. Only in these two situations, a person is eligible to obtain Aadhaar. In other cases, it is not mandatory to have Aadhaar in India to transact in India. So NRIs are not required to have Aadhaar in India. Another thing is about the OCI card. As far as the OCI card is concerned, it is required to enter into any kind of financial transactions, especially when it is to do with investing in India. Or even if someone is not having a OCI card but is having the eligibility to have a OCI card, even then a person can invest in Indian financial assets or real estate. Recently, the Indian government has mandated all the persons, all the taxpayers to link their Aadhaar card with the PAN, the permanent account number, in the income tax website. Uh, this is mandatory for all the persons who are already having a Aadhaar card. So if you have already got a Aadhaar card, then it is mandatory to link this Aadhaar card online with the PAN. If you do not have Aadhaar card, then there is, and you are not even eligible to have Aadhaar card if you are living outside of India. And if you do not want to obtain Aadhaar card now, then it is perfectly fine. And there is exemption that has been provided for NRIs to obtain Aadhaar in India. It is not at all mandatory to have Aadhaar. And many cases that we come across wherein because of this not non-linking, the PAN has become inoperative, meaning the income tax department has frozen the financial transactions of many NRIs in India. In these situations, we can definitely help, which we have done for so many of the persons, to substantiate to the income tax department that I am an NRI and I'm not required to obtain Aadhaar. So please exempt me from of this requirement, and that has made it that has again streamlined the process and has removed this condition, and the PAN has become completely operational now. Taxation of incomes in India is something which is very important. The basic concept is that any income that is arising in India or is received in India directly is liable to tax in India. For any NRIs, there is applicability of a DTAA, a Double Taxation Avoidance Agreement. So India has got a DTAA with UK and several other nations, all the major nations of the world, wherein there are beneficial or concessional tax rates that are given to all persons who are UK tax residents like you, if you are living in UK predominantly, and if you have got incomes in India. So these concessional tax rates are for dividend and interest income in the DTAA with UK. So if you are a UK tax resident living in UK, and if you have got dividend incomes in India or interest incomes in India, they are taxable at 20% or at slab rates, which could extend up to 30% and beyond. But because of these DTAA benefits, it is reduced to 10% and 15% flat, including all the cess and surcharges. And NRI has got an option to opt for whichever is beneficial. So let's say a scenario wherein the interest income is very low and the overall income is also less. In that case, the rate of tax for the interest income might be lower than 15%, which is the concessional rate of tax that is announced. Even in this case, the NRI can opt for whichever is beneficial, as I mentioned, so slab rate, or if someone wants to obtain the concessional rate of tax, it is also an opportunity that is available. Another major benefit of this treaty DTAA and its implication to any NRI who is living in UK is that the way it would work is that in the first place, whenever someone has got an income in India, which is arising out of any activity, in that case, it will have to be offered for taxation in India when someone is filing the tax returns. And whatever is the tax implication that is arising will naturally have to be paid in India. Thereafter, since UK has got a concept of global income taxation, the incomes that are there in India will have to be again reported in UK while paying the UK tax, while filing the UK tax returns, which I have mentioned in the third step. And in this case, what would happen is that since the taxes for those incomes are already paid in India, UK will give a relaxation or a credit or a set off for whatever are the taxes that are paid in India. To that extent, UK will give the tax credit, and only the additional tax that might be arising is something that will have to be paid. Let's say if you have got some kind of interest incomes in India, which might be taxed at effectively 20%. And if those incomes, when offered for taxation in UK, are taxable at 30% as per your UK tax structure, then the difference, the additional 10% is something that needs to be paid in UK, whereas the taxes which are paid in India are available for a tax credit. This is the benefit of the India-UK DTAA, which is there. This is something which is understandable, and we can understand the concept of tax credit. But here we need to understand that the UK tax year is from 6th April to 5th April, and the Indian financial year is from 1st April to 31st of March. Also, the currencies are different. So in order to mitigate this kind of a difference, what we do is that we prepare a comprehensive international taxation report wherein for every UK-based tax residents, wherein we convert all the incomes that have arisen in India from INR to GBP, and as per the UK tax year period, which is from 6th April to 5th April. So all the incomes which we have enlisted in this sample report, which is the actual report which we have prepared for one of our clients, and in that we have enlisted all the incomes from different sources that might be arising in India, converted into GBP, and calculated the tax that might be applicable in India. So it is clearly understandable in the sense when someone is filing the UK tax returns, then someone can figure out that this was the amount of tax that I had paid in India for these incomes. So this is the tax credit which I need to avail in UK while paying the UK taxes for those Indian incomes. Moving further with the concept of succession, this is also something which is very important. And as we know, as important as it is to build wealth, it is equally important to pass it over to the successors of those assets. A common question regarding this aspect that we receive is that what happens to my Indian assets if I am based in UK on my death? Will the succession be triggered as per the succession laws which are applicable in India or in UK? Because the assets are India, but I am a resident of UK. In this situation, as far as the assets in India are concerned, it would be happening as per the succession laws which are prevailing in India. And this is how actually the succession would happen, wherein if the person has made a will, then the succession is called as testamentary succession in legal terms. In that case, the succession would happen in accordance with whatever has been made in this Indian will. And if the person has not made the Indian will, then the succession would happen as per the applicable personal succession law. So for all persons belonging to the Hindu community in India, it would be applicable as per the Hindu Succession Act. So whatever are the legal who have been mentioned, whenever someone dies intestate, meaning whenever someone dies without making a will, then whatever are the family members who have been mentioned, they become the successors of the assets. For example, if it's a male who dies without making the will, then the spouse and the children, all of them have an equal share in the property of the male if the person died without making a will. This is one of the common misconception that we have often come across in several of the cases. Whenever we talk about making a will, the importance of the succession aspects, then the natural answer and the response to that we receive is that I've already made my spouse or my children or whomsoever I want to bequeath these assets as the nominee for these investments. So I think that is good enough, and they'll get the ownership of these assets in my absence. This is a misconception which I would want to clear. Nomination gives custody of the investments. We must understand that custody and ownership are two separate things, and a person who is a custodian only has a right to keep that assets, but does not have the right to own that assets. So to give you the real owner for this would be the person who is either mentioned in the will or is mentioned as per the applicable succession law. To give you or to explain you further with the help of example, let's say if a person, a male who dies, has made his spouse as the nominee of these investments, and he wants to bequeath all his assets to this spouse, and on the death of this person, if the person dies with kids, with children, then all the children along with this spouse have a equal ownership to these assets. And if the person they had not made the will, then even though the wife would get the nominee, the custody of the assets, even in this situation, the children can challenge the wife for their own share of in the respective property because a will was not made, and as because nomination is merely giving custody or to the person. Once a person realizes the importance of this of making a will, the immediate response to that is that whenever we come to India next, which is maybe after a few years, we'll think of making a will if there is we have enough time. One thing which I wanted to clear here is that as far as the aspect of requirement of physical presence in India is concerned, for any person who is based out of UK is concerned, then it is not at all required. A valid will, Indian valid will can also be made sitting in UK comfortably. The only thing is that it should have all the essentials of a valid will, which is predominantly it should be signed by two witnesses, and the person who has made should be made should make it in writing, and it should be ideally basically attested by a notary public there in UK. And there should also be declarations which are called affidavits, which should be made by both the witnesses to just to affirm that the will was made by the person in a sound state of mind. Moving with the second part of today's presentation is about investment planning. Uh, Firstly, we all know that India is a resurgent economy these days. Why do I say that India is a resurgent economy? The answer to that is quite simple. It is the fastest growing economic power in the entire world in the top 20 economies right now, surpassing not just the developed economies of US, UK, Australia, but also the emerging economies of China, Indonesia, all the other developing economies by a decent margin. Even if we look at the stock market performance, which is the barometer of the economy, then the stock markets in India in the last 3 years have done quite well, in the sense the small cap and the mid cap indices which are there, they have been amongst the best performing indices in the entire world, despite of the fact that in the recent past, very recent past, last year, the Indian markets have not done that well. Despite of that, if we look at the last 3 year period, then the returns of these mid and the small cap companies, which are not the top companies, the largest and the most popular companies. But beyond that, these companies in India, then they have done quite well if we look at the global peers and other indices. Let us now understand as to what are the drivers for this economic resurgence. First is the demography, the thriving young population, which is almost at par to become the largest in the world and quite skilled and educated. Second is the democracy. Our country has witnessed a stable government in the last decade, which has been able to deliver several reforms, especially in terms of the financial reforms. The fiscal deficit has been reduced, which is the deficit the government has been reduced to a manageable level. The tax reforms, especially on the GST front, the income tax front, along with the recent reforms that have been announced, have been very, very noteworthy. The capital markets has also been very transparent and has been recognized for its investor protection measures across the globe. The public sector has witnessed a sharp revival in terms of its profitability as well as the growth. The central bank, which is the Reserve Bank of India, has been very successful in controlling the credit flow and in curtailing all chances of any kind of financial stress. Geopolitically, India today stands to be extremely powerful, which we have been seeing and witnessing day in and day out. I did not say anything. Wherein it's aligned with major superpowers in the sense that is able to garner the economic policies to its own advantage. Digitization and financialization, these are two buzzwords right now in the Indian economy. And India today has got the cheapest data facility in the world. And UPI is nothing less than a revolution in India, with every smallest of the business persons, including a roadside vendor or a Kirana store owner, transacting in UPI with the internet user base, which is also beyond our imagination. Financialization with a huge amount of retail investments flowing into the financial markets, our domestic institutions have become extremely resilient. Consumption is also something which has been very fast growing in India, especially with the recent taxation in terms of income tax as well as GST reforms that have been announced, as coupled with the government expenditure. Infrastructure across the length and breadth of India is witnessing a sharp change. There's been a countrywide development, and this is a remarkable achievement because we are in a democratic setup wherein every person has a right to oppose, every person has a right to question what is happening. Manufacturing, as we discussed in the earlier part of today's presentation, has witnessed a sharp revival in the last few years. There have been a lot of gains because of the China plus one strategy, and a lot of multinationals outsourcing their manufacturing to India and several other South Asian economies. And this has been coupled with the initiatives of government, which is why the Indian exports have also crossed record levels. Mahakumbh, I'm sure few of you would also have visited. And this might be sounding to be a religious event, but I must tell you that this has been a major economic event in India, wherein there have been total spending to the extent of 3 trillion rupees, which is the kind of total income that has been generated in India. So this is a major economic event which has benefited the Indian GDP to a very good extent. Now, this is all fine. This all sounds to be really appealing. But how can someone like you make the most of this and participate in the resurgent Indian economy? The simplest means to do that is investing in the Indian equity markets through the route of mutual funds. The entire India has now accepted that mutual fund investing is the most popular and convenient means of investing, and a well-designed portfolio in India comprises of all these three parameters, which is the financial profile of the investor, meaning the incomes, expenses, assets, liabilities, the kind of savings that the person is able to do, the risk appetite, what is the level to which the person can accept volatility or fluctuation in the investments, and after all, what are the goals for which the investment is being made. SIP, systematic investment plan, is a very effective means today to the extent of 27,000 crore rupees every month. The investors are investing through SIPs in Indian mutual funds. And the mutual funds comprises of all these different kinds of categories that I have mentioned in the slide, which is large and mid, flexi, multi. And appropriate distribution across all these categories is something which is very important. A few other parameters which also need to be considered is the AMC concentration, meaning to what extent is the portfolio concentrated in each mutual fund. It should not be too concentrated into a fewer ones, and it should also not be too diversified. Also, quartile performance, benchmark comparison are parameters which are very critical to be evaluated in terms of a mutual fund selection. This is a data matrix which we use called as key performance indicators in terms of recommending mutual fund schemes. I have illustrated this in order to explain you as to what are the different parameters that needs to be considered whenever we are selecting mutual fund schemes to be invested in India. To give you an example of a few, portfolio turnover ratio, meaning the number of times the portfolio, the stocks in the mutual fund has changed, is something which is very important to know. The comparison with the benchmark, which is BSE 250 small cap in this case, Sensex, Nifty are the most common benchmark indices that we have all heard of. But comparing the returns of the scheme with the benchmark is something which is very important. Quartile performance, meaning dividing the entire basket of mutual funds into 4 parts in ranking of the performance and ensuring that the fund is either in the first or the second quartile, meaning in the top 50% in terms of the ranking, is also something which is very important. Other than that, also there are several other parameters which I will not go in detail in interest of time, but this is the overview of it. Once the investment is made in mutual funds, reviewing the portfolio on a regular systematic basis is also something which is very important, which most of the investors who are investing often fail to do. So we conduct a thorough review of the entire mutual fund portfolio on an annual basis and recommend whatever are the changes so that the portfolio remains agile, in tune with the changing trends of the economy, and is dynamically managed. Another means of investing in the Indian equity markets is through portfolio management services. This PMS is basically a basket of stocks which are invested through a separate brokerage account called as a demat account in India, which is started by the asset management company which is running the PMS for the investor. So the brokerage account is in the name of the investors. Shares are bought and sold in the name of that investor itself. The only thing is that which stocks to sell, which stocks to buy at what price is something that is outsourced to the asset management company. The choice of the strategy, meaning multi-cap, small cap, mid-cap, the way we have got different schemes in case of a mutual fund, the choice of the portfolio strategy is something which we can select depending upon the financial profile of the investor. The way it is different than a mutual fund is that, number one, there is a concentrated portfolio of stocks, meaning PMS comprises of at the most 20 to 40 stocks, whereas a mutual fund has got 50 to 100 stocks in its portfolio, which is why the PMS performance can be more aggressive and better in the longer run. The regulatory restrictions which are there in case of PMS are lesser naturally than a mutual fund. For example, in case of a mutual fund, there is something called a stock specific cap, meaning a particular mutual fund cannot own more than 10% in a particular stock or a certain percentage in a particular sector. Well, in case of a PMS, the fund manager has got a free hand to select whatever kinds of stocks that someone wants to buy and sell. The other difference is that the PMS is not impacted by the inflows and outflows of other investors in the portfolio. So mutual fund, as we know, is a pool of funds. So if there are other investors who are putting in money or pulling out money, it impacts the entire pool. But in case of a PMS, since it's a separate earmarked brokerage account, inflows and outflows of other investors does not impact that particular investor. And the minimum investment amount is 50 lakhs of rupees in case of the PMS. Similar to a mutual fund, these are all the different data parameters that we use to select a PMS strategy, including the past performance, the fund manager, the amounts that are managed, the sectors that they're investing, so on and so forth. Moving beyond the shores of India is global investing. As we know that the US markets are the mother markets and are quite big in the sense they are the largest market in terms of the overall market capitalization. So the way a person living in UK may want to diversify the investments in India, it is also advisable to diversify it into US, which we have enabled through this platform that we have built for all our investors, wherein it is a platform that is started along with the broking partner for Dry Wealth. And there is a fixed fee which is involved on the total portfolio value. There are no brokerages, there is no account opening charges. The funds are remitted directly from UK to US and vice versa. So there is no implication in India, no taxation that is triggered in India. And naturally, US does not have taxation on capital gains. So this is something which is the kind of overview or the layout of the platform that we have developed, which is very user friendly. And these are some of the sample portfolios which we have curated for our investors. Recently, we also curated portfolios on themes like space tech, AI, and these are the other ones which are there, the big tech companies, which we all know of. These are some other sectors, some other kind of portfolio strategies which we have suggested our investors to invest. The present investments that we discussed were all in the equity markets, which is the stock markets of India and US. There is also the opportunity to invest in fixed income in India through guaranteed income strategies. So what happens is that there is a fixed amount of investment that needs to be made for certain years, and the monthly income would start from the very next month from which the investment is made. And this would continue for very long tenures, as long as 30 to 40 years. The idea behind this kind of an investment is that it is something that is guaranteed. The income will continue come what may, whatever are the changes that might happen in the economy or the stock market or the interest rates. So the Reserve Bank of India has been reducing the interest rates regularly. So this would assure that we get a fixed income for very long tenures. And there is also a death benefit which is associated in this, which is 10 times of the amount of premium that is paid. And the maturity proceeds, which is the income that I mentioned, the monthly income that is received, is completely tax-free as long as the premium is restricted up to 5 lakhs of rupees per year. So a lot of people that we come across in UK have got dreams to spend the golden phase of their life, which is retirement in India. That is a wonderful thought to have, but it should be coupled by financial planning. And that is possible through both the means in India, through the fixed income guaranteed plans that I mentioned, which are for very longer tenures with a very attractive kind of a return, and also ensure flexibility, and also through the equity oriented options, wherein a corpus can be created into equity mutual funds. In the way we have got systematic investment plans, there are systematic withdrawal plans through which we can withdraw the corpus in a very tax efficient manner in India. The balance corpus, which is not withdrawn, keeps growing. And it is also very flexible in the sense it can be reduced, it can be increased, depending upon the requirements from time to time. Certain practical insights that I wanted to share with you. This is our interaction with several people living in UK. Real estate in India is something which is always fascinating to a lot of people. And we often come across questions as to how worthwhile is it to invest in the Indian real estate. no matter it sounds very lucrative and attractive to explore Indian real estate investment with the kind of infrastructure development that is happening. But we must understand that liquidity, meaning selling of a real estate property at the desired price, meaning within the desired time, is a major challenge. Managing a real estate property in terms of safekeeping it if it is a land and maintaining it if it is a constructed property like a residential apartment or a commercial property is a major challenge. The entire process of dealing in transacting in real estate, which is investments, disinvestments, and remittance, is something that is very tedious, requires a lot of time and effort. The next generation of most of the people living in UK are not keen to forget about relocating, even visiting India on a regular basis. So handing over that kind of a legacy of real estate properties to them may not be a very good idea. As long as someone is planning to self-use the real estate property, it might be worthwhile. But in other cases, financial assets are a much better means of investing than real estate in India. Depreciation of currency. Of late, this has been a major concern for a lot of people living in UK with the kind of sharp depreciation of the Indian rupee that has happened against the GBP. I completely understand the fact that the depreciation that has happened in the last 2 years precisely has been much sharper. But whenever we are investing, we look at a long-term horizon. When we are structurally investing, we look at a horizon of at least 5 to 10 years. If we look at the rate of depreciation of the Indian currency against the British pound in the last 10 years, and if we annualize that, as in what has been the depreciation of currency on a year-on-year basis in the last 10 years, then it has been merely about 1.5%. So it might sound that this is the kind of abnormal depreciation which has happened and which may have continued to happen. But if we look at the longer horizon, then it hasn't been that bad as what is seems in the recent past. If we are to predict the depreciation going forward from now, then we must understand that this depreciation of currency is on account of two major factors, which is the demand and supply of the Indian currency vis-a-vis the foreign currency. Now, in the current context, there have been a lot of structural investments that are flowing in India in form of the FDI investments with the Tesla and the Apple setting up their manufacturing facilities in the world, which is why there will be a lot of inflows of funds in India. And the inflation in India is also at a very controlled level now, which is why the difference in the inflation is also something which is quite low at present, which is why the depreciation of currency would not be as sharp as what it has been in the past. Another challenge which we often hear from many people living in UK is that the taxation in UK, especially for high income earners, is abnormally high. So even if we invest in India and even if we earn a hefty return in India, a lot of it would be eaten away by the high rates of tax in India. We must understand here that taxation is universal and neutral. When I say universal, wherever a person is investing, whether it's in UK or in India or in any other part of the world, taxation is something that is going to happen. So if these funds are not invested in India, if they're invested in UK, even then we have to face the taxation on the incomes. And even if they're invested at some other third place, even then we have to face it. When I say neutral, I mean to say that because of the double taxation avoidance agreement, whatever are the taxes that are paid in India, someone can get a tax credit in UK. So there is no double taxation. And as such, the tax rates of UK, if they are higher, and naturally they are on the higher side, that is the ultimate liability which someone will have to bear. But ideally, the pre-tax investment return, meaning the returns before considering the tax, is something that we should consider to take and evaluate the investment decision, because taxation is even, is neutral and universal. Gift City, as we know, is a very interesting development that has happened in India in the recent past. And I'm sure all of you would have come across this interesting development that has happened in India, either by way of some or the other hearsay or some or the other media report that has come up. What is this Gift City? Gift City is an international financial center, services center that has been started in India. And the vision of the present government is to make it like any other global financial center of the world, which is, let's say, DIFC in Dubai, Singapore, or Hong Kong. So that is the idea behind setting this up. And this is a special economic zone. So the exchange control regulation of India, which is FEMA, is not applicable in this zone. And there are a lot of benefits that have been announced to the financial services sector in this area. Also, there are a lot of benefits under the Indian Income Tax Act that have been announced. How can someone living outside of India make the most of this investment? Through the Gift City. There are Gift City funds which have been started. The technical name being Alternative Investment Funds Category 3. Now, these are all registered and set up in the Gift City. And these funds basically invest in the Indian mutual funds. The same old mutual funds which have been in India since not years but decades altogether. So, any individual living outside of India who could be a person of Indian origin like you or a company, let's say if there's a company based in UK or a trust in UK or a partnership firm or any other form of entity, it can invest into this Gift City fund in its own name, in its own capacity. And this fund would pool money and in a funnel like arrangement, invest into the Indian mutual fund. So this is like a fund of fund. The advantage of doing that is that there is no Indian tax implication either to the fund whenever it sells the units of Indian mutual funds or to the investor whenever he, she, or any other entity sells their holding in this Gift City fund. So this tax implication is not there. Also, there is no requirement of since there is no tax in India, then there is no requirement to file any tax returns in India. No tax assessments that are involved, and there's no requirement of even opening a brokerage account in India or even a bank account in India. So the funds would flow directly from the UK bank account to the Gift City fund and back to that account whenever we redeem the investments. The investments are also denominated in USD, and the onboarding process is also very simplified. To summarize the entire chain of activities, what would happen is that the investment happens in these Gift City funds called as alternative investment funds in the Gift City. And then these funds would invest in the Indian mutual funds, which naturally invest in the equity shares, the stock market. And whenever these are sold, meaning whenever the fund sells the investments and when the investor sells the investment in that Gift City fund, it would be tax-free and it can be repatriated seamlessly. The advantage of this is quite simple, quite understandable in the sense there's no tax implication. There's no requirement of opening any bank account, brokerage account, and the investments are denominated in USD and is basic KYC that is involved. A final message by our Prime Minister at the recent World Leaders Forum, wherein he talks about the reforms that have transpired in the last decade. And we all know the kind of change that it has brought to India. And I'm sure whenever you visit India, you would be witnessing it your own self, is something which is beyond the imagination of all of us and will definitely make India a developed nation by 2047, which is his vision. A final disclaimer that the presentation had personal views, and wherever we have used any kind of references, we have mentioned the source of it. This is a glimpse of our event that we had last year in UK, which was a very successful one, and we were fortunate to interact with maybe I think hundreds of persons across UK, across all these three locations. And similar to this, we've also organized several webinars, especially for UK audience in the last few months. A brief about us before we move forward is that we have a legacy of more than 65 plus years being a one-stop solution provider for all kinds of financial services. And we have a team strength of more than 60 persons across the different domains of finance, with active office presence across the western belt of India in the cities of Ahmedabad, Rajkot, GIFT City, Mumbai, have cumulatively managing more than 1,000 crore rupees of assets, predominantly in the Indian markets, in the Indian mutual funds and PMSs, and also in the US markets for more than 5,000 clients spread across 25 plus countries globally. As far as our services are concerned, we're into complete management of investments in India, be it in Indian mutual funds, PMSs, in Indian private markets through AIFs, as well as the US markets, as I mentioned. GIFT City, as I mentioned, is something that is coming up very well. We have our own office, which is there in GIFT City, and we bring a lot of GIFT City solutions wherein any investors can invest in the Indian stock market through the route of GIFT City. We are also into Indian income tax compliances, meaning tax return filings, assessments, everything end to end, as well as advisory for Indian income tax. Estate planning is also something which is very important. We help in preparation of Indian wills as well as private trusts wherever there is a need to do so in India. Insurances is also something which is also something which we are into. We are insurance brokers dealing with all life insurance offerings in India. International tax compliance support, as I mentioned about and discussed about the report, the comprehensive report that we prepare as per the UK currency, as per the UK tax year, and this is very useful in terms of bringing convenience in UK tax filings. As far as financial regulations advisory is concerned, we help in repatriation of funds outside of India, planning for any other kind of financial transaction, and also in coordinating with the banks wherever it is required. Now, the advantages for anyone who is working with us is that there is a single point of contact for anything and everything that they can think as far as Indian financial affairs are concerned. In other words, we're like a family office to them for all their financial activities in India. This is all possible through a single point of contact of a relationship manager from our side, who is backed by all different specialists in financial domains. This brings a lot of convenience to the person who is working with us and to us in terms of discharging a holistic financial advisory, and eases the tax compliance since all the data is available with us. So far as our charging mechanism is concerned, all these ancillary services that I mentioned, be it the tax filings, the estate planning, international tax compliance, is all complementary that we provide as long as the investment portfolio is managed by us. If any one of you happens to visit any of these locations, it would be a pleasure to meet you in person and interact with you further. Thank you so much for sparing your valuable time. The entire presentation will be sent to you via WhatsApp so that you can view it. And along with that, we'll also share the YouTube video link of the recording that has happened of today's session. So you can again view it whenever you want, and you can share it with whomsoever you want. It's really great, and I appreciate the fact for you to join this on a weekend. Thank you so much for being such a pleasant audience. And if you have any questions, I'll be more than happy to answer. The first question is, if someone already holds Aadhaar card, do we need to submit it back? There's no requirement of submitting it back. The only requirement is that the Aadhaar card needs to be linked on the Indian income tax portal with the PAN, and there's a very simple procedure to do that. Once that is done and it's all done, there's no further requirement from there. The another question is that is inheritance tax applicable in UK for property and assets in India? What are the limits for that? So as far as our overall professional service is concerned, We are basically into Indian laws and Indian financial advisory. UK related advisory is something that we are not into. Maybe Mr. Vipul Patel would be a right person to guide you for the same. As far as the treaty is concerned, India UK DTAA, then we can guide you on that as well. But as far as the UK law is concerned, we may not be the right persons to professionally opine on that. The another question is Aadhaar card is not mandatory for on NRIs. Does that mean that there is an option for NRIs to obtain Aadhaar card? I've always been denied since I am an NRI. As I mentioned, Aadhaar card is only available in two situations. Either the person is an Indian passport holder or the person has got a stay in India in the last 12 months or for more than 182 days. If you do not fall in any of these two conditions, then you will be denied the Aadhaar card. And Aadhaar card, as I mentioned and I repeat, is not at all mandatory in India. So there is no requirement to obtain Aadhaar card. Should we make will of Indian assets in India or in UK? Also, should we make a single asset of the UK and India, or should we make two separate wills? The answer to that, I would say, is that we should make two separate wills. You may or may not mention about the Indian assets in UK that you can look into considering the UK succession law aspects. But definitely you should have a separate will in India for the Indian assets. So, because whenever there is a requirement of a succession in terms of a transfer of a legal title, there is a probate which needs to be obtained by the court to establish the validity of that will, which is required in many of the cities in India if the properties are located there, or if a person is belonging to that city. Then in this situation, whenever a probate needs to be obtained from the court, the physical copy of the will needs to be submitted. So if there is a separate will in India, then it is always practically better and advisable. So Indian will separate Indian will is something which is a must, which I would definitely suggest. If
Hi,
the,
I have a follow-up question on what you just explained, Rajit. Thank you. Um,
sure.
what are the complications of having an Indian will and we are living here? You did mention the word probate for the verification of the person, whether he's living in a particular city or not. How does that work for Indian wills and the properties which are located in India?
Sure. So, the way it would work is that in the first place, the will needs to be made. It should have all the essentials of a valid will, which I had discussed in the presentation. Once that is made, that is notarized, then the role of the will would come once the person dies, and thereafter in order to establish the title for the successors for the properties of the deceased person, a probate is something that may have to be obtained depending upon the location. So certain cities in India have got probate which is mandatory to be obtained. Now the way it works is that the physical copy of the original will needs to be submitted to the court, and the court will issue a probate basis. That probate is nothing but an order of the court mentioning that this is the final will and this is binding to everyone. So basically that is something that needs to be done, which is an additional process. As I mentioned, if the assets are located in certain cities in India, or if the person belongs to certain cities in India, in that case, this probate needs to be obtained by the court. Now, this probate application has to be made by anyone on behalf of the deceased person, ideally the executor of the will. And thereafter, basis this probate, the successors of the assets, which could be your children, your spouse, your family, or any other person, will get title of the ownership in the revenue records. Revenue records are the local government records wherein the ownership is transferred. This is with respect to the immovable property that I mentioned. As far as the financial assets are concerned, which is the movable property, the nominees would get custody or the title as soon as the person dies. In that case, the nominees would step into the shoes of the deceased person, and it's quite simple. But the process that I mentioned earlier is especially for the immovable property.
Okay. And can the transfer be done while sitting here in UK, or do we have to be in UK, India to do that? And that also too when the will is not available? How does that work?
Okay, when you say transfer, do you mean transfer in terms of the transmission on death of the person? I believe that is what you mean.
Yeah. Yeah.
In that case, ideally, the executor needs to be present to make the application to the court for the succession of these assets. But if the executor can give the power of attorney, meaning the authority for any other person to represent and make this application in the court. So if the person is not present, even that is fine. But the original copy of the physical will is something that needs to be submitted. So that is something which is mandatory. But any other person, representative, can make the application on behalf of the person who is deceased.
And then the overall process gets complicated if the will is not there, right? Then additional step needs to be taken in terms of the next of kins available in the family, right?
Correct. If will is not there, then it would happen as per the Hindu Succession Act. And there's a different procedure to it for the succession, which would get triggered.
Okay, all right. Thank you. Thanks very much.
Welcome. Yeah. Okay, I'll move further with the other questions. If the will is made in UK, does it cover all assets, India and UK? So as I mentioned, as far as the UK will is concerned, it is always better if you take opinion of a estate planner based in UK for whether the Indian assets needs to be disclosed there or not. Long-term MF investment due on ongoing UK depreciation except does not. Right. So if as far as the the evaluation of the investments in India is concerned, in Indian mutual funds, considering the volatility in the currency, and then if we look at the kind of performance that has happened, the overall returns that have transpired in the last 10 years, and even if you reduce the currency depreciation of 1.5% from that, the returns are exceedingly well. So they are amongst the best performing markets. Of course, I understand US markets, especially the NASDAQ and the tech stocks have done equal or even better. But definitely, even if you reduce the depreciation from the portfolio returns of all the portfolios that we have been managing for 5 to 10 years and beyond, and if we reduce the depreciation of currency from the kind of returns that they have delivered, even then it is almost at par with the US markets, because even in the 3-year basis, it has given 22% compounded returns. In the last 10-year period, the annualized returns in Indian markets are quite attractive. So, the depreciation of currency, even if we negate that, it has been attractive. And yes, so US market is definitely there, but then diversification into emerging markets is also something which is definitely worth considering. The other question is about the GIFT City. As far as the proceeds of GIFT City funds are concerned, they would directly get credited to the UK bank account, and they would be received in UK. So as far as taxability in India is concerned, India does not tax GIFT City funds, as I mentioned. As far as UK is concerned, it would be taxable in UK as per the rates of capital gains that may be there applicable on those kinds of investments in the funds. Okay, the next question is about the pricing model of the services offered by our firm. As I mentioned, the way we work is that we provide all kinds of different investment services in all options, including the Indian markets, US markets, the equity markets, private markets, through GIFT City, everything depending upon the requirements of that individual investor and the financial profile that is there. And then once a person is associated with us, as far as the investments are concerned, we do not charge them directly because we are remunerated by way of brokerages like any other financial advisor in India who is remunerated by way of brokerage incomes from the asset management companies. We are also remunerated that way. But as an add-on or as a value-added service, what we do is that we also provide the other ancillary services, which is the taxation compliances, the estate planning services as far as India is concerned, the repatriation, financial regulations related advisory that is applicable. So everything and anything that has to do with Indian financial affairs is something that we provide, and we do not charge anything directly. We are remunerated by the asset management companies. Thank you so much for the kind words, for the appreciation. And I think I'll take up the last question about the minimum investment amount. About for the GIFT City AIFs, it's 150,000 US dollars. The only thing is that if someone proves to be a accredited investor, then the limits can reduce. To make that happen, basically there needs to be a certain net worth that needs to be established in terms of the financial assets that are owned or certain levels of incomes. In that case, the relaxation is given to these accredited investors, and thereafter it can reduce to 75,000 US dollars for the GIFT City funds. But in most of the funds, it is 150,000 US dollars as of now, which is the minimum investment amount for the GIFT City. I think that is it. So if you have any other further questions, we can definitely connect later on. And our contact details are something that would be shared with you along with the presentation. So it would always be a pleasure interacting with you. And yeah, so thank you so much for being a patient audience once again today. And I look forward to seeing you all maybe virtually or physically someday later. Thank you.